Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The major recent feature here on this daily chart is no more. The gapping changeover action in mid-May has been filled in, and without actually causing another gap in the process as well. The base of the move higher was made 3 weeks ago for well highlighted, by me at least, 3-day bullish morning doji star pattern. This move up also set aside the opportunity for a February 2021 to date huge long-term bear flag. I'd previously spoken about the downside potential of this and how it was almost reached down the 1120 zone, considering how I'd highlighted a pattern a few months ago when prices were at 1400 and 1500 or higher. Yet we didn't quite get there. Added to this, I had for a few weeks now spoken about the longer term charts and explicitly the 5-year moving average, currently at 1183. This ultra long term moving average plus the 2021 low at 1181 provided a reason for the mid-May to mid-June hesitation and aversion from going lower. I said 2 weeks ago it was worth keeping a close eye on these, and so it's turned out. This all brought beans back again once more into the teens. The two key pieces of action for the move up were provided last week by a pair of opening long white Marabozos. The first did most of the gap filling and the second punched up through some key resistances. These resistances were the combination of the base of the late 2022 descending triangle that you can see edging out to the left of my daily chart, and the lesser Fibonacci line, both at 1378. This was a key resistance that is now support. And we had lesser Fibonacci lines at 1389. This one was the top of the big changeover gap, then at 1400 to 1409. Then resistance at 1400 and 1409. All these were congestion levels as well, and are all now supports. Then yesterday saw another significant move higher, up through and closing over the declining medium moving average, currently at 1426, and the flatlining long moving average, currently 1439. It was interesting as these two had formed a dead cross only 2 weeks prior, a lagging indicator. The close yesterday was the first over both of these moving averages since early April. However, the market stopped short of testing the next significant resistance, the 50% Fibonacci line of big December 2020 to February 22 move at 1451, which has beyond it another big 50% Fibonacci line of the February 2022 to May 23 move at 1476. The failure to test these resistances may go some way to explaining why today prices have opened lower and pulled back below both moving averages. This opens the bigger question as to what is going on here. Well, I would look at the action since May as a possible V-bottom. Now, the V-bottom is usually seen as a bullish reversal pattern, but it may not necessarily lead to higher prices. You see, we have to study what the market does at the neckline, and on this formally gapping chart, it can be difficult to do so. However, I suspect if there was to be a neckline near here, then it would be either the lesser Fibonacci line at 1389 or the combination a little lower at 1378. There's one subset to the V-bottom that also needs to be considered, and that is the extended V-bottom pattern. This happens at the end of a usual V-bottom formation, but then instead of heading in one or other direction, the market starts to form a flag or a pen or even a sideways triangle in some cases. Once this pattern is completed, often a bearish piece of work, then the market resumes the original direction, in this case up. There is the possibility here for such a pattern, with the previously mentioned lesser Fibonacci line at 1389 and a combination of 1378 likely as the base of such an action should it decide to happen. So I'll wait and see how far this pullback lower will take the market. Chicago soybean meal commentary. I will no longer start this commentary after today by noting the monthly key reversal down here in March. This was the key and the start of a big move lower since March, and it is done. As for the bigger picture here, well, that has once again for months and months now had different patterns crashing in and out of each other. The biggest pattern here had been the May to date broken, then repaired, then broken again, ascending, expanding wedge pattern. A huge pattern that I pointed out many months ago. It was never a perfect pattern by any means, but it's finally started working in late May. To assist in seeing this pattern, I highlighted it here on my daily chart in dark blue. How the upper trend line is slowly exiting top left of my daily chart, but the lower trend line, currently at 425.90, is still here in dark blue. And there's also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. The break lower in May below this trend line and neckline combination indicated a potential primary target that is still well off the bottom of my daily chart at the incredible 324 zone, and a secondary much harder to reach target in the 283 zone. These are the ones you can write in the back of your diary and maybe look at once or twice a year. However, with the resurgence back up in the last week or so, we've seen prices postpone or delay any potential targets below and instead concentrate on the top side. Thus, since my last commentary, the market's punched up and closed over the following: the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60, the declining short medium moving average currently 420.5, the congestion of the neckline and lesser Fibonacci line at 425.90, the early 2021 high plus congestion highs from January and February 2021 at 433.5, and finally yesterday's slowly rising long moving average, currently 436.80. Now the market stopped short of testing the next resistance, the April 2021 high, much as it did in early and mid-May. Be aware of that. Now last week I laid out two possibilities for this market at the time. This was after the market had formed a 3-day bullish morning star pattern at the turn of May into June, and I quote, "There are two ways to look at this. The first is to look at the action since mid-May as a potential for a small bearish half hesitation, much as the one we have between mid-April and the end of May. The second way is to look at the action since mid-May as a possible double bottom in formation. This would rely on the 2020 low and the low of May plus the lesser Fibonacci support at 381.40, all holding up the market. I am agnostic on either one, but I would observe the longer we stay around these levels, the more opportunity there may be for a further move lower." End of quote. Well, we didn't stay around there very long. The market obviously chose the double bottom pattern with a subgroup of being an Adam and Adam type instead of the bearish halfway hesitation. But where does this leave us now? Well, we've exceeded any topside targets for a double bottom, but there is still the chance for one, maybe two patterns to form from this. The first thing to look out for is whether the market forms a handle or sideways trading area after forming the double bottom. It is still too early to see that right now, but the top side of the April 2021 high plus the long moving average, and now the declining medium moving average, currently 442.80, moving down on top of the market, may be the start of defining where the top side of the handle could possibly be. As to what pattern may come after this consolidation period, if it is of course happens in the first place, but I have an idea that I'd like to share with you, and that is, if we do form a handle, then perhaps, just perhaps, we could have a potential May to date reverse head and shoulders pattern, with a split head of course. This is still a long way away, but I thought I might lodge that idea here just in case. This brings me to my final point, which I raised 3 weeks ago. On my long-term monthly charts, with less than half the year gone, 2023 is set to be a possible annual key reversal. Thus, if we were to close on New Year's Eve this year, 2023, either above 471 or under 399.10, then we'd be on. Anything in between would have a lesser outside year. Right now we're looking at a possible outside year, but we have still so many months still to go. Chicago soybean oil. The key pattern here, which I highlighted some time ago, is the late November 2022 to early June 2023 descending wedge pattern. This is easily seen as it is highlighted in purple on my daily chart. It was not a perfect pattern. You could hardly expect it to be after over 6 months of continuously watching the market try and thread in between the trend lines until 2 weeks ago, when the market broke higher out of the pattern. So for such a confirmed break higher, there would be a primary target in the 67.5 area for such a pattern, with a secondary hard to reach target X1 for such a pattern in the 78.20 area. For nearly 2 weeks, this all looked set to be on course for the primary target. However, at the end of last week and the start of this week, prices ran up into a wide and interesting band of congestion between 57.64, 15 and 59.44, which I had highlighted, and it has the old August 2011 high within it, and a little above it we have the slowly declining long moving average, currently 60.64, which is near another congestion band, smaller one, between 61 even to 61.11, and that has the 2011 high at 61 even in this part of it. Anyway, the outcome was that prices failed their rally and dropped down through a lot of resistance that became support that has turned back into resistance again. This consisted and consists of the September 2012 high at 57.64, the 50% Fibonacci line of the March 2020 to April 22 move at 56.34, the slowly declining medium moving average, currently 54.99, the February 2013 high at 54.15, gapping down through that one at the moment, and only stopping today at what can be seen by some as a last chance support for the bulls. The combination of the short medium moving average, currently at 52 even, and the 50% Fibonacci line of this whole move up over the last 3 and a bit weeks, and that's at 52.07. So where does that leave us now? Well, we are still above the descending wedge pattern. So we still have those potential targets above. But anyone who thinks that moves we've seen this week don't impact those targets is deluding themselves. At best, this week's actions have put those potential targets back, possibly quite a bit. At worst, we have a false break higher in the descending wedge pattern. Personally and consciously realizing I do have a conservative nature about such things, I would still consider the break higher to still be a live one, but, and it is a big but I would consider this descending wedge pattern may have lately been morphed into a possible descending scallop pattern. In this pattern, we would need to see prices drop back to the lows of late May, and only then, perhaps, would I expand on this idea further.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.